Good afternoon, everyone. I welcome you in our income tax class for today's session. Today, we will be discussing again the provisions for income under the head capital gain. This is our third session for capital gain chapter, and we have already gone through with the basic concepts of capital gain, like the chargeability of section 45. Then we have discussed already the provisions of capital asset, the definition of transfer, the concept of indexation. Then we have gone through with the basic provisions how to index, and that is before 23rd of July, the provisions was different in case of long-term capital asset. And on or after 23rd of July 2024, the provisions for long-term and indexation has been changed. Then we have gone through with the provisions of section 47, in which transfer will not be regarded as transfer. There was almost 15 cases in which we have discussed that those cases in which transfer will not be regarded as transfer. So technically we can say those were the cases in which no capital gain would be charged in that year. But after that transaction, which has been undertaken under section 47, after that, when the new assessee will transfer those assets in the future, then the capital gain provision would be applicable. And you have seen that we have also discussed the Manjula J. Shah concept in this case also. So those were the provision we have discussed. Then we have discussed advance money forfeit provision, the cost of acquisition, the cost of improvement concepts, how we will find the cost of acquisition and cost of improvement in different categories of assets. So those were the revision part, what we have already discussed. So Mr. B. Kiran Kumar is asking, sir, in the last week class of capital gain before MCQ on part conversion of debenture to shares for share cost acquisition, indexation was taken as base. It is applicable to only for unlisted company. I think to listed companies, indexation not applicable. Please clarify. In case of listed company, we have both option exists there. Either you can opt for indexation, then you have to pay tax at the rate of 20%, or either you can go for without indexation concept in which you could pay tax at the rate of 10%. So that was the provision till 23rd of July, before 23rd of July. After that concept, this concept has been abolished. So what is provision for listed company, what is for unlisted company, that will be discussed in chapter 2, or we can say part 2 of capital gain, in which we will discuss what kind of taxation, how taxation will be imposed, and in that case you will see that these listed concept has been there also. Okay. Okay, Pranav. Okay. I forgot to upload the chart of cost of acquisition. I will definitely going to upload it today. Do not worry. So, as usual, before starting the class, let's share the thought for the day. It says, be stronger than your excuses. So definitely you all are doing the same kind of study. You all have to face the same kind of question in your examination. More or less problem will be there in your life, of course. So circumstances would not be same for all of you, but you have to come out of that. You have to fight for your goal. You have to fight for your dream, etc. So be stronger, whatever you excuses you give, that you cannot study because there was some marriage or you are ill, etc. So those could be excuses, but you have to come over it because you are the one who actually needs to describe your future. You are the one who's going to create your future. So be stronger than your excuses. Okay. So moving on to the notes. In the last class, we were discussing the provision. Discussed the provision regarding sale consideration in case of transfer of capital asset by a partnership firm to the partner or vice versa. So we were on section 45.2, I guess, that is conversion of capital asset into stock in trade. Tejaswin is asking, sir, COI of previous owner will be taken only after 1401. Yes, you are absolutely correct, Tejaswin. Cost of improvement will be taken only if it has been incurred on or after 1401. So any cost of improvement that is before 1401 is going to be completely ignored, completely. And we have already discussed the point regarding it. Let me show you again. Before the indexation concept, it has been specifically mentioned that this point number 1 you can see on page number 7, that is cost of improvement incurred before 1401 will be completely ignored. Whether it's done by a previous owner or it has been incurred by the assessee does not matter. But any cost of improvement done by assessee or previous owner, both are liable to be deducted by the assessee. Okay. So moving on to conversion provision, conversion of capital asset into stock in trade. So when we have gone through with the definition of transfer under section 247, in that definition, there was a point which talks about conversion of capital asset into stock in trade. And I have told you that we will discuss that meaning, the interpretation, and the proper detail of that provision when we will discuss section 45.2 in detail. So today we will discuss section 45.2 in detail and we will understand what is the meaning of conversion of capital asset into stock in trade. So on page number 26, we have the concept, we have the provision which will govern the conversion of capital asset into stock in trade. So section 247 is specifically stated that if you have a capital asset, and if you convert that capital asset into stock in trade, that will amount to transfer. So capital gain provision will be imposed. And in that situation, how we will calculate the capital gain? We will discuss the full concept in this provision. As well as, first of all, we should understand how capital asset or in which situation capital asset could convert it into a stock in trade. Let me show you with the help of an example. After the break, we will also discuss MCQ. So you should have a paper, pen and calculator after the break session. Okay. So what is conversion of capital asset into stock in trade? Suppose there is Mr. D and who is a doctor. Clear? He has purchased 3 buildings on suppose 1st April 2012 at the rate 10 lakh rupees each. So because he's in the profession of doctor, he's a professional doctor. So these houses or building, we can say, would be treated as his capital asset. Of course, these are technically capital asset. Now suppose what happened, Mr. D also started a business of being builder. And he thought whatever building he has as spare, why should not he convert those building into this business of builder so he can transfer those building as a sale. So what he did, he transferred these buildings, or technically we can say he converted or he introduced these building into the business of being a builder as a stock in trade, and as on suppose 1st April 2022 we decided. So the provision says the day of conversion would be treated as transfer. Under section 247, the conversion of capital asset into stock in trade would be treated as transfer. So what will happen? So now income tax department will say there is a transfer, and when there is a capital asset, we have already this thing what is like it is a capital asset, and we have transferred also. So both condition fulfill. So section 45 will apply, that is charging section, and it will say now capital gain would be imposed in this case. Now suppose on the date of conversion, what would have actually happened? There is no money has been received by Mr. D because we did not sell that property. We just converted that property in our books of accounts from the head or nature of capital asset into the nature of stock in trade. So what will happen? Any cash inflow would be there or not? If we are doing this, any cash inflow would be there or not? Of course, there would not be any actual cash inflow. Suppose what must be happening, suppose there is a building which was earlier written down in the fixed assets column, suppose 10 lakh rupees. So three buildings was in the definition of fixed asset 30 lakh. Now when they introduced or converted them as stock in trade, so now this building will be from the definition of fixed asset, now it would be shown under stock in trade. So there would not be any extra cash inflow in respect of transfer or conversion of these buildings. So what would be the problem on the conversion date? Suppose the FMV was 50 lakh each. Clear? So if the FMV is 50 lakh each, then what would happen? If we try to calculate the capital gain in this year, practically what will happen? That's a different thing. But suppose agar technically we will see how much gain he has. So technically 150 lakh for three buildings, 150 lakh consideration. Forget about the indexation. So 30 lakh would be the cost, 10 lakh rupees each. So for three buildings, forget about the indexation right now. So there would be at least 120 lakh rupees capital gain. And the tax rate upon it is 20%. So technically 24 lakh rupees tax he needs to pay. Surcharge and cess would be additional. So approximate almost 24, 25, 26 lakh need to be paid by Mr. D on 1st April 22. But now understand the exact problem. The major problem is something else. What is the major problem? He does not have any money. Due to this conversion only, the nature of asset has been changed from fixed assets to current asset in his balance sheet or in his books of accounts. There is no real cash inflow in his pocket. So if income tax comes to at his door and asks, okay, now you have capital gain, congratulations, you have a capital gain of 120 lakh rupees. So you have to pay 25 lakh rupees. Suppose today we converted our capital asset into stock in trade. And in tomorrow morning, department has come to us. Just to give an example and ask you, give us 25 lakh rupees tax. You will say, how I will pay tax? We do not have money. So they will say, no, section 45 says if there is an asset, if there is a transfer, then you have to pay the tax. So this was a practical problem that Mr. D cannot pay the tax because he does not have any money. Suppose this gain is 5 crore rupees, then the tax would 20% would be 1 crore rupees. So it is practically impossible that somebody can pay without having the real money in his hands. So department made special provision for conversion of capital asset into stock in trade. It says that if there is a conversion of capital asset into stock in trade, we will consider it as a transfer. In this year, we will say yes, transfer ho gaya. But because the person cannot practically pay the amount of tax, so we are shifting the chargeability. The chargeability of this capital gain is shifted into the year in which stock in trade would be sold. Suppose there are two situations happening. First of all, capital gain should charge in the year of conversion. This is the legal provision that it should charge. We will assume transfer in the year of 2022. We will assume that the transfer in the year 2022 and capital gain tax should be recovered from assessee in this year only. But due to the practical problem, due to the not actual cash inflow of the money, department shifted the chargeability in the year in which stock in trade would be sold. Now suppose stock in trade has been sold on 10th July 2024 at the rate 80 lakh each. If he transferred two buildings, we will calculate capital gain on two buildings. So we will do this thing. 80 lakh rupees each for two houses or two buildings as stock in trade. So there were transferring of three buildings. Conversion was three buildings. But we will charge only capital gain on two buildings because the stock in trade has been sold only for these two buildings. So for assessment year, 25, 26. Only the year would be, the year of chargeability would be that year in which stock in trade is going to be sale. All the other provisions would be applicable assuming as asset has been transferred in 2022. And you can see practically and technically, we are saying that asset has been transferred in 2022. But because there is no actual cash flow, so we will collect the amount of tax in assessment year 25, 26, or in the year in which stock in trade has been sold. So due to this, we will take the chargeability in assessment year 25, 26, and there would be two chargeability, the business head and the capital gain, because stock has been sold. So business income calculation also required. An asset has been chargeable in this year. So first of all, how to calculate capital gain in this year? So I have told you that just we need to take this year for chargeability. Everything else will be applicable assuming asset has been transferred on 1st April 2022. So transfer is technically is April 2022. So what should be the period of holding? The period of holding would be from 2012 till 2022, because asset has been converted into stock and trade in 2022. So that would be long-term capital asset. Now the sale consideration. So it was the FMV if that asset has been sold in the market at the time of conversion. So we must have collected 50 lakh rupees each. So the FMV would be treated as sale consideration in the year of stock in trade has been transferred. So this 80 lakh cannot be the sale consideration because it is for stock, not for asset. So if it is for asset, then the consideration would be definitely of 50 lakh rupees. So whatever was the FMV at the time of conversion will be taken as sale consideration. So my sale consideration for two buildings would be 100 lakh rupees less index cost of acquisition. So for index cost of acquisition, there must be need to find out the cost of acquisition. So cost of acquisition would be 10 lakh each. So two properties, it's 20 lakhs. So what index I should use for the multiplication? For the multiplication, which year index we need to use? Okay, answer me which year index we need to use. Okay, so which year index we should need to use? Correct. Tejaswin is saying 21, 22. Yes, the transfer year index we need to use always. The transfer year index. And what is transfer year? The transfer year was financial year 22, 23. Tejaswin, you are incorrect. It's not 21, 22. The conversion takes on 1st April 22. So financial year 22, 23 index need to be utilized, not 21, 22. Clear? So we need to multiply with 22 and 23 financial index, which would be given in the question. Let me tell you, when we solve the questions of capital gain or we do practice of questions of capital gain, in majority of cases, like in 90% cases, we use index always for previous year 24, 25. So it is in habit that we always use 363 in the upper column for the purpose of multiplication. Always we do this. We write down 363. So please avoid these kind of mistake, because in these kind of question, the transfer year would not be previous year 24, 25. It would be something or some other year. So we always keep in our mind that when we use the index for upper column, we have to recall one that what is the transfer year. So because the transfer year is 22, 23, so we will use the index for 22, 23. And for the purpose of this lower, for the purpose of dividation, we use the index for 12, 13. Whatever here would be the index cost of acquisition and balance would be your long-term capital gain. Okay. Chat is, I guess, disabled. मिस्टर अशोक, चैट टेक टीम में से कोई है? चैट is disabled. Can we on the chat? Miss Bhavna is saying, sir, but actual sale not take place, so no amount will be received. So why calculate capital gain? No, no, actual sale, because section 247 says that in the conversion will be treated as transfer. So when the section says it is a transfer and there was a capital assets, so capital gain would be chargeable to tax. But the problem was that, Bhavna, that we do not receive any money technically on this date. So department defer the chargeability in the year in which you will get the actual money. Okay. So chat has been enabled, students. You can ask your questions over there. That will be, I guess, more easy for all of you. So there would be capital gain. Now in this kind of question, the examiner would also ask to calculate the PGBP income. So how we technically calculate the PGBP income? The sale or the purchase? The difference would be your profit. So now stock has been sold for 80 lakh rupees for two assets. So the sale consideration would be 160. Now what should be the purchase? The amount which has been taken as sale consideration in case of capital gain would be treated as purchase price for the purpose of PGBP income. Why? Because if these assets has not been converted by you, then our business must have been purchased it from the outside. And what was the market value at that time? That was 50 lakh rupees. So technically, if we would have purchased these assets from the market, we would have paid 50 lakh rupees for each asset. So whatever will, it is a universal rule, whatever would be the sale consideration over here would automatically become the purchase in case of PGBP. So in this case, the business income would be 60 lakh and the long-term cap gain would be this value, whatever it would be after the calculation. I hope it's clear. $50 lakh is FMB and what more take for 100 lakh? 50 lakh was FMB on one for Tambeshwari for one building and we transferred two building as a stock in trade. So for two building, it would be 100 lakh. Okay. So that was the case how we need to calculate capital gain in case of conversion of capital asset into stock in trade. It's a very simple trick. You can all rely on that. Only use assessment year of that year in which stock in trade has been transferred. Stock in trade has been sold. Everything else, period of holding, index, consideration, everything else would be taken on the basis in the year in which conversion takes place. Okay. So this is a trick. You can solve these kind of question with these tricks easily. Okay. So these are the provision. Section 45(2). A person who is the owner of a capital asset may convert the same to treat it as a stock in trade. Let me tell you before this, we are discussing this topic. Like the general provision was, we always charge tax capital gain in the year asset transfer. The normal provision, what we have discussed earlier, in those provision, we have seen that we always charge capital gain in the year in which asset transfer. We are discussing the exceptions of these cases. Like these are the special cases what we are discussing in this head. That any profit and gain arising from transfer of a capital asset affected in the previous year are shall be chargeable to income tax under the head in the previous year in which transfer took place. So this is the normal provision as per section 45. But now we have some exception. There are some exception. In these exception, the chargeability year and the transfer year is different. So first example was conversion of capital asset into stock in trade. Other would also come over here. So in all these exceptions, there are only one condition, that the chargeability year and the transfer year would be different. Okay. So first was the case of conversion of capital asset into stock in trade. Mr. Kiran Kumar is saying, so please explain also conversion of stock in trade to capital asset. That is a part of your PGBP provision. So I believe the faculty must have discussed these provision under your PGBP head as you have already completed your PGBP classes. Okay. So the conversion provision says a person who is the owner of a capital asset may convert the same or treat it as stock in trade of the business carried on by him. As noted above, the above transaction is transfer. As per section 45.2, notwithstanding anything contained in section 45.1, being the charging section, the PGBP after conversion or treatment will be chargeable to income tax in his income of the previous year in which stock in trade is sold. What would be the full value of consideration? We have discussed FMV in the transfer year. Whatever was the FMV at the time of transfer would be the sale consideration for capital gain chargeability. Capital gain arising on conversion of capital asset into stock in trade shall be chargeable to tax in which previous year in which stock in trade is sold by the SSC, and FMV would be treated as the sale consideration. So I have also make a short or small you can say format for each these kind of provision for the better understanding. Like house purchase in 2012 for 10 lakh rupees, converted in stock and trade 2016. FME was 30 lakh. This house is sold for 55 lakh rupees in May 2024. So transfer year would be still 2016, but capital gain would be charged as previous year May 24. So the year of chargeability would be assessment year 25-26. Period of holding will still remain the same. FMV would be the sale consideration, which in this question is 30 lakh rupees. The cost would be normal. It would be indexed, of course, and resultant would be your capital gain or loss. Chargeability year Pallavi would be assessment year 25-26. Transfer year was 20-23. Chargeability year will be that year in which stock in trade is going to be sold. So here's a question also. A is the owner of a car on 1st April 2020. He start a business of purchase and sale of motor car. He treat the above car as part of stock in trade of his new business. He sells the same as on 31st March 25 and get a profit of 1 lakh rupees. Discuss the tax implication in his hand under the head capital gain. So what should be the treatment under the head capital gain in this scenario? Okay, somebody answered. Hardik is saying it's a personal asset, so no treatment. Well done. Of course, car has been treated as a personal mobile asset. Abhishek is saying car is a mobile asset, so no cap gain. Abhishek, let me correct you. You should write like it like this. Car is a personal mobile asset. Both conditions should be fulfilled. If this car belongs to already a business, that is a business asset, then this treatment would not be the same. So he's the owner of a car, so that means this car is now for personal purpose and he converted that car as a stock in trade. So for the purpose of capital gain, if you have any personal movable asset, then it should not be treated as capital asset. So there would not be any treatment under the head capital gain. Correct. Next is X converts his capital asset acquired in June 10, 2003 for 60,000 into stock in trade. On March 10, 2020, the fair market value on the date of above conversion was 5,50,000. He subsequently sold the stock in trade, so converted for 6 lakh rupees on 10th June 2024. Discuss the chargeability of capital gain. So of course, the FMV on the date of conversion, that is 550, would be treated as your sale consideration. Other provision will remain the same. The chargeability year would be assessment year 25-26. So the solution has been written over here. You can go through it. Mr. A converts his capital asset for an amount of 50,000 in June 2003 into stock in trade. In the month of November 16, the fair market value of the asset on the date of conversion is 4,50,000. That stock in trade has been sold for 6,50,000. So business income would be 2 lakh rupees. You can see the stock has been sold for 650 and the FMV was 450. So PGBP income would be 2 lakh rupees. Now the capital gain, the sale consideration would be the FMV, that is 4,50,000. The purchase price was 50,000. So we will use the index of 1617 and 2003-4. That would be index cost of acquisition, and the balance would be long-term capital gain in the assessment year 25-26. So you can see the provisions are discussed over here with the solution. Next is on January 31st, 2025, Mr. A transferred self-generated goodwill of his profession for a sale consideration of 70,000 and incurred expenditure for such transfer. So that's a personal goodwill of profession. It could not be taxable. We have already gone through with this case in the cost of acquisition provision. So the first example of that exception in which the transfer year and the chargeability year would be different in case of capital gain was conversion of capital asset into stock in trade. The second is this destruction of capital asset. So any one of you would tell me what is the or what should be the treatment, or what should be the definition in which destruction has been included under section 247. We have discussed the definition of transfer. So what destruction would be treated as per transfer definition under section 247? Hardik is saying relinquishment. Very well done. Yes. Aisha is saying relinquishment. Well done. Rashmi is saying not capital gain. No, Rashmi, you are not right. But in case of destruction of asset, we have discussed two cases in which one is not chargeable under capital gain and the other would be chargeable under capital gain. And that was destruction of asset with insurance. So if you have an asset and it has been destroyed, and if it is insured, then only we will apply the provision of destruction of capital asset under capital gain chapter. Now, why we are discussing this topic under the exception part? Again, the same concept. Suppose we have a asset which has been destroyed in 2022. But it is not necessary that we will get the compensation from the insurance company that year only. It is not mandatory. The insurance company would take time for the verification, survey, reports, etc., etc., and then you might be able to get the compensation. So the chargeability of capital gain again would differ in this case also in the year of realization of compensation. So transfer year would be the year of destruction. But because there is a destruction in that year and there might not be any amount received from insurance company in this case, so that could not be treated as a chargeability year for the benefit of assessee. So exactly the same concept which was in the conversion of capital asset has been taken in destruction of capital asset also, and we will charge this capital gain in the year in which the insurance compensation will be received. I hope it's clear. Just give me a second. So the provision says that destruction would have the same character, exactly same character, in which the conversion of capital asset into stock in trade was there. So the concept would be exactly the same. The transfer year will remain the year of destruction. The chargeability year would be the year in which your amount received. What would be the sale consideration? Of course, the amount received from the insurance company would be your sale consideration. All other provision would remain the same. So you can see Capital gain arising on destruction of capital asset will be chargeable to tax in the year insurance compensation will receive. But period of holding will be taken from the date asset required till the date of destruction. Okay, the same time period we will take, no other specific provision. So where any person receive any money or the asset under any insurance from an insurer on account of damage, destruction, riots, accidental, because of action of an enemy, etc., whatever the reason, whatsoever. The capital gain shall be deemed to be the income of such person for the previous year in which money or other asset was received. So you might get the money or you might get that asset which has been destroyed. So the fair market value of the asset which has been given by the insurance company would be the sale consideration in this case. Okay. Whatever is the full value of consideration, in order to compute capital gains, the value of any money or the fair market value of other asset on the date of such receipt shall be deemed to be the full value of consideration. The format in front of you, of course, the money receipt will be your sale consideration, whatever is cost or index cost, as the case may be, would be applied. So now the third case is compulsory acquisition under section 45(5). Again, this is also an exception. So now what is exactly happening in case of compulsory acquisition? Let me make you understand with the help of an example. So what is compulsory acquisition? Under section 45(5). So this was also written in the definition of transfer. And we have said that we will discuss these provision in detail when we will study section 45(5). That is compulsory acquisition under any law. Suppose you have a property, you have a land, and that land need to be acquired by the government for any bridge, road, airport, infrastructure, or whatsoever reason. So if you have any asset or any property which has been compulsory acquired by the government, and for that government is ready to pay you the compensation. So that compulsory acquisition would also be treated as transfer, and the compensation you will receive will be your sale consideration. Understand? So the compulsory acquisition is treated as transfer as per section 247 definition. Now again the problem is same. Suppose you have a property, you have a land or building or whatsoever asset, and government asked you that we are going to compulsory acquire that property and we will pay you. Listen carefully. We will pay you compensation of 50 lakh rupees. So in 2024-25, government say we acquired your property and we will pay you the compensation. Again, the problem could be like this, that it's not mandatory that you will receive the compensation in the same year. Maybe government pay you the amount next year, after 2 years or 3 years, or maybe in installment also. So again, the problem is the same. Suppose you have property purchased for 50 lakh rupees. Government say we will pay you compensation for 3 crore rupees. So you have the profit of 2.5 crores. An income tax came at your door and asking, give us the tax upon 2.5 crore rupees profit. So what you will say that I do not receive the amount yet. I could be paid this amount, or I am able to pay the amount of tax only in the year in which government will pay me the compensation. So income tax say yes, he is absolutely right. If he does not have any money, how he would be able to pay the amount of tax? So again, the chargeability here has been changed in case of compulsory acquisition also. Transfer year would be the year in which property is going to be compulsory acquired, but the taxability would be in the year in which compensation received. Clear? Let me tell you with the help of an example. It's very interesting and a little complicated also. It's not as simple as in case of conversion of capital asset or in case of destruction of asset, because there are multiple circumstances or consequences also. What will happen? Let's discuss one by one. Suppose here is Mr. A. He is having a land. which he purchased on, suppose 1st October 2012 for rupees 10 lakh. Cost of improvement 1 lakh rupees done by him on 1st October 2015. Now this land has been compulsory acquired by government on suppose 1/10/2020, and government say we will pay you compensation. The compensation decided at the time of acquisition is called original compensation. The original compensation as per government would be 70 lakh rupees. Will be. Original compensation will pay. So government say we will pay you. So if this compensation has been received in this year, then there was no issue. We will chargeable to tax in the same assessment year. The assessment year would be 21-22, but practically it would not happen. Or of course in the question again it would not happen, because otherwise the question would be very simple for you. It would not be the part of exception. So now what happened? This would be treated, compulsory acquisition would be treated as transfer. It has been specifically treated as transfer to section 247. But again, the problem is same. If we find out the profit is approximate 60 lakh rupees, upon that 60 lakh rupees, 20%, that means 12 lakh rupees tax approximate is there. But how Mr. A able to pay that tax until he will receive the amount of compensation? Clear? So the provision has been made that the chargeability, capital gain, the provision has stated that capital gain would be chargeable to tax. Listen carefully, would be chargeable to tax in the year full or part of the amount of original compensation. We call it in short OC, original compensation OC received. Now there's a very interesting thing. It says full or part of the amount of original compensation received. So technically the original compensation has been decided 70 lakh rupees, and capital gain would be chargeable in the year in which either we receive 70 lakh or any part of it. Suppose we receive only 20 lakh rupees. Suppose we receive 20 lakh rupees from original compensation on 1st October 2024, suppose. So even we receive only 20 lakh rupees, but for the purpose of taxability, we will take sales consideration full 70 lakh rupees value. Clear? So now in the assessment year 25-26, we are going to charge the capital gain. And again, the year would be this. Everything else would be taken from that year in which property was compulsory acquired. So the period of holding, of course, would be 2012-20. The sale consideration would be the full value 70 lakh rupees less index cost of acquisition would be 10 into previous year 12-13 index, sorry, the transfer year index, which would be for financial year 20-21 upon 12-13 index. For index cost of improvement, this is 1 lakh into 20-21, and index will be 15-16. So we will have our long-term capital gain or loss, whatever it is. That is going to be taxable in this year. So you might be thinking, this is exactly the same as per conversion of capital asset into stock in trade or kind of destruction of capital asset. But dear students, There's a lot more to come in this scenario. It is not completed yet. Now, there could be a practical issue that in some cases, the assessee demands extra compensation. Assessee is not satisfied with the compensation of 70 lakh. Assessee say, no, I need more compensation. I need at least 30 lakh more compensation. The total compensation should be 1 crore and you have already decided or calculated 70 lakh rupees. So I need some extra compensation. So assessee went to the court against government that I need extra compensation. We called it EC, that is enhanced compensation. We use the term enhanced compensation of 30 lakh rupees. The court decided the case, court listened to the government also, court listened to the assessee also, and court decided, yes, this should be allowed. So the final order of the court has come on, suppose, 1st October 2026. So if any enhanced compensation has been finally ordered by the court, then this is also going to be taxable in the assessment year that final order has been given by that court. So that means if the final order has been in on 1st October 26, so we are talking about assessment year 27-28, we are going to taxable this enhanced compensation, but there is an issue, or you can say there's a good news. You need not to calculate any period of holding in for the enhanced compensation. The sale consideration would be the value, 30 lakh. The good news, the cost of acquisition, cost of improvement always be nil. Why? Because you have already deducted all the cost of acquisition and cost of improvement when you calculated the original compensation. So this 30 lakh is a bonus. You did not expend any amount on the cost of acquisition or cost of improvement. In case of this extra money, yes. If there is any expenses on transfer, like court fees, etc., that could be deducted, but the cost of acquisition and cost of improvement would be always nil. So what should be the nature of this gain? The nature of this gain would be remain the same for the nature of enhanced compensation capital gain. So this was long-term cap gain. So this will also be automatically long-term capital gain. So if it is short-term, then it would be called short-term capital gain. So we have two kinds of compensation. Original compensation would be taxable in the year in which the whole or part amount of that original compensation has been received. The enhanced compensation is going to be taxable in the year in which the final order of the court has been given. No cost of acquisition, no cost of improvement could be deducted from enhanced compensation. Only expenses on transfer can be deducted as expenses of transfer. So it's not yet complete also. Now there is one twist in the story. Suppose in the above example, when assessee went to the court for EC, suppose when assessee went to the court for EC that we need 30 lakh more compensation. So in the first instance, we have supposed that court has allowed it. So the treatment was over here, but it is not mandatory that it will happen. Suppose the court order was in favor of government. Court rejected EC. So if court rejected the EC, then nothing need to be done. But suppose court rejected the EC and reduced. Court says the original compensation was also higher than the limit. It should not be 70 lakh. Courts reduce the original compensation to 60 lakh only. And this order has been given on 1st October 2026. So now there would be a very interesting problem. So EC treatment is zero in this case. There is no requirement to calculate any EC. We do not need to do any treatment of that EC. But in 2026, we came to know that our OC should be 60 lakh. But we have already received the OC of 70 lakh and we have already paid tax on this OC. Already paid. Assuming it's 70 lakh in assessment year 25-26. And now court says, no, it should not be 70 lakh, but it should be only 60 lakh rupees. 10 lakh already has been given wrongly to the assessee, which should not be there. So now we have two options. One option, if we have a time machine, then we can go back into the time and we can change our capital gain calculation of assessment year 25-26. We should recalculate that in assessment year 25-26 with the help of a time machine, replacing 70 lakh by 60 lakh, and we can calculate the tax again. So it is the one option if we do have a time machine. Second option, we do not have a time machine. So now we can do what? We need to recalculate the capital gain in assessment year 27-28. We are going to recalculate the original capital gain. Again, in assessment year 27-28, everything else would remain the same, like period of holding, etc. वो सब same रहेगा, उसमें कोई change नहीं होगा. Nothing would change in period of holding, etc. Only one figure is going to be changed, that is sale consideration. Earlier it was 70, now we will calculate it with the help of 60 lakh. All index cost of acquisition, index cost of improvement will remain the same. There would not be any change. But my capital gain would be changed. Due to this, my tax liability change. I have already paid tax upon higher value because I have took the sale consideration 70. So because my tax liability change, so if I have paid extra tax, that is going to be refund in this year. So if court enhance the compensation, that would be an easy case for us. But examiner could ask, suppose in the above case, if there is no enhanced compensation and the original compensation has been reduced, so then we have to recalculate the original capital gain by taking the new sale consideration in place of the old sale consideration, and whatever extra tax you have paid would be refunded to you accordingly. So now this is section 45.5. So you might have seen that this have multiple implication. So this is more important for from the point of view of examination. And you know what? When this kind of question is going to be framed in your examination, it would be at least 1.5 page. Because examiner need to write a lot of things. When Mr. A purchased the property so and so in this year, and the cost of improvement has been done in this year, and the government needs to construct a road. For that road, he needs to acquire the property of Mr. A. So we decided to do for compulsory acquisition, decided the original compensation of 70 lakh rupees, which need to be paid in second year or third year. Then so on, case went to the court for the EC, and the court allowed the enhanced compensation in the year of so and so. The final order has been passed, and then in the end it would be written, suppose in the above case if there is no EC but the OC is also reduced. So you can imagine how lengthy that question should be in the examination paper, at least 1.5 page. So you should not get scared of it because the solution is very easy. You can see we are not solved anything very complicated. This is a normal case we have solved. Then the EC solution is very simple. You just need to find out the real year in which we need to tax it. That's it. Then the full value is going to be taxable. And if amount has been reduced, what we need to do? Nothing. We just need to change this sale consideration from 70 lakh to 60 lakh. So the solution is very easy in comparison to the question you might have seen in the examination paper. So that was the case. Very interesting question. Let me see. Okay. Legal acquisition, like in case of non-repayment of loan. Pallavi, no, this is not the case. If it is in case of repayment of loan, it would be called extinguishment of asset. This is only the case of compulsory acquisition by government under any law. That is not by government, that's by finance company or bank. So that is a part of extinguishment, not this part. Lahari is asking, sir, can assessee demand more original compensation and decided earlier? Okay, we have discussed that, of course. Lahari, your query might be clear already. So in the case of compulsory liquidation by land by government, a certain part of the land in case of road construction, few people just donate the government. In that case, no tax need to be paid. Few people, if you are not receiving any consideration, then why we need to pay the tax? I'm not getting your question, Praveen. Few people just donate to the government. So if you did not receive any consideration, you gifted the property to the government, of course, there would not be any tax in your end. Next is, sir, for OC of 50 lakh, when it will be received, then no tax. Correct. Absolutely correct. The OC has been decided 70 lakh. And we tax full 70 lakh when we received only 20 lakh rupees of that amount because the provision says that. So when the remaining 50 lakh would be received in the future, there would not be any taxability on those 50 lakh rupees. Nitin is saying case study jaisa. Yes, of course. Jasak is saying, sir, if this question asked of 45.5, then whole case is explained, not only the part asked. I didn't understand, Kasak, what you are exactly asking. You might be asking in respect of theoretical question. In the theoretical case, it has been asked that what is the compulsory acquisition and kindly elaborate or explain the taxability of it. Then definitely you have to explain all these things. These have been written in notes also. Okay. So when we are going to discuss the provision via notes now, so you can see everything has been stated in the notes also. So for delay in compensation payment, then how interest income will be treated? Kiran is asking. Kiran, that interest income is going to be taxable under income from other source. 50% interest would be exempted and 50% balance is going to be taxable under income from other source. This is also has been written in the notes. We are going to discuss these notes one by one. So you can see the pictures. So the whole scenario you can understand. Okay, what is the meaning of compulsory acquisition? So if any capital asset, okay, if any CA, it's not chartered account, it is capital asset, okay, it is capital asset, is compulsory acquired under any law, then it amount to transfer and chargeable to capital gain, but we will calculate that amount in the year in which OC, EC is received. So OC is original compensation, EC is enhanced compensation. Taxability of compensation has been given over here in detail. In case of OC, whole compensation will be taxable in the year in which whole or any part of the whole compensation is received by the assessee. Also, here is a format to make you understand the provision very easily. Transfer year will be the year in which property compulsory acquired, but capital gain will be charged in the year compensation full or part received. Period of holding would remain the same. Total original compensation, whether received full or part, will be the sale consideration, and the cost or index cost, whatever is the case, going to be reduced. The taxability of EC. Many times person whose capital asset have been taken over by the central government or who get compensation from the government go to the court of law for enhancement of compensation. If the court awards a compensation which is higher than the original compensation, the difference thereof would be or will be chargeable to capital gain in the year in which the same is received from the government. Cost of acquisition in case of enhanced compensation. For this purpose, the cost of acquisition and cost of improvement shall be taken to be nil. EC, in case of EC, there would not be any cost of acquisition and cost of improvement. Compensation received in pursuance of an interim order deemed as income chargeable to tax in the year of final order. So it would be taxable in the year of final order. You can go through with the provisions. Here's a format you can see. We can only the cost, etc. would be nil always. Now the third case, that is reduction of enhanced compensation. Where capital gain has been charged on the compensation received by the assessee for compulsory acquisition of any capital asset or enhanced compensation received by the assessee, then subsequently such compensation is reduced by the court, tribunal, authority, the asset capital gain for that year should be recomputed or recalculated, taking the new consideration into the calculation purpose. Death of transfer, if it is possible that the transferor may die before receive the EC, in that case, EC will be chargeable to the tax in the hands of the person who received the sale. Now, the provision regarding taxation of interest on compensation and enhanced compensation, because generally government do not pay in the year of compulsory acquisition. So your OC or EC might receive due later. For that, the government pay the interest also. So what is the treatment of that interest amount is over here. So whatever amount interest you have received, 50% of that interest would be exempted and only 50% is going to be taxable under income from other source. Suppose the interest was 3 lakh rupees. So 1,50,000 is going to be taxable as income from other source. Even if in the question it says that for 3 lakh rupees interest, some collection expenses has been done for 10,000. So net you receive 2,90,000. So not 50% of this, the gross value 50% would be your income from other sources. Clear? So those were technically the 3 cases we have discussed in which the year of chargeability and the year of taxability, the year of transfer and the year of taxability are different. One was conversion of capital asset, then we discussed the destruction of capital asset, and then we are discussing on compulsory acquisition under any law. Now we are discussing a special provision in which we have an amendment also. We have discussed the concept of short-term capital asset and long-term capital asset. And before 23rd of July 2024, the definition of short-term capital asset and long-term capital asset were different. There was a time duration of 12 months, 24 months, and 36 months for different categories of asset to be a long-term or short-term. But on or after 23rd of July 24, there are only 12 months or 24 months criteria is there. But there are certain asset which has been specified going to be treated as short-term capital gain. That is also we have discussed in the definition of long-term and short-term capital assets. So the section 50AA we are again discussing because now we are discussing how to calculate capital gain on these specific assets. So transfer of unit of a specified mutual fund or market-linked debentures or unlisted bond or unlisted debenture. Section 50AA provides for the computation of capital gain in case of transfer or redemption of maturity of units of a specified mutual fund on or after 1st April 23, market-linked debenture or unlisted bond or unlisted debenture which is transferred or redeemed or mature on or after 23rd of July 24. They all will be treated as short-term capital asset. Now, very interesting thing is there in respect of this. Like if there is unlisted bond or debentures, if those have been matured or transferred on or before 23rd July 2024, then we have to check whether they are long-term or short-term, depending upon the provisions. If they have been held for a specified time period, and if now we have sold before this date, then we have to find it out whether it's a long-term asset or it's a short-term. But if these unlisted bond or debenture has been transferred, matured, or redeemed on or after 23rd July 24, then always short-term, there is no need to find out the period of holding. Again, in the examination, you have to remember this provision. Then if that is an unlisted bond or debenture, then if the transfer has been taken place before this date, then we have to find it out whether it's a long term or short term. Accordingly, we have to apply the provisions. But if the unlisted bond or debenture has been transferred on or after 23rd July, it would always be short term. These two to always short term. But for the third asset, unlisted bond debenture, you have to check whether it has been transferred before or after. Section 50AA will have an overriding effect in spite of anything contained in section 242A. The section which describes the long-term and short-term capital asset, which defines a short-term capital asset under section 48, providing the manner of computation of capital gain, that is indexation. So accordingly, capital gain arising from transfer, redemption, or maturity of a unit of a specified mutual fund on or after this date, market-linked debenture or unlisted bond or unlisted debenture, if transferred on or after 23rd of July, they would always be treated as short-term capital gain and chargeable to tax at normal rate of tax. There is no special rate of tax for unlisted bond, debenture, market-linked debentures, or units of a specified mutual fund. What are the tax rate, etc.? That is going to be discussed in part 2 of capital gain. How to calculate capital gain? Of course, no indexation would be there because they are going to treat as short-term capital asset. So full value of consideration we need to take and reduced by the cost of acquisition and expense on transfer. No reduction in respect of STT, security transaction tax deduction cannot be claimed in any case. Okay. So we are discussing some special cases. We just discussed a special case of market-linked debentures. They will always remain short-term. Unlisted debenture or bonds if transferred on or after 23rd of July. Or the other asset. Now we have a special provisions for transfer of share in case of liquidation of company under section 46. So these are separate specific question, and in the examination, a question related to specifically liquidation of company, buyback of shares, depreciable asset, slump sale, conversion of capital asset into stock in trade, compulsory acquisition, or just we discussed the unlisted debenture, etc., could be asked in 3 marks or 4 marks, etc. So these are separate provisions and not very difficult. They are easy to understand, but they having effect that they could be asked in the examination as a separate question. Hardik is saying, sir, bond never had an index benefit, then why that rate is mentioned? Because capital index bond is having indexation advantage, Hardik. Capital index bonds, sovereign gold bonds, we have discussed, they are having the benefit of indexation, of course. Now, liquidation of company. So capital gain on distribution of asset. So because there are distribution of asset in case of liquidation by a company. So when there is a capital asset and there is a distribution or transfer or sale, so automatically capital gain provision would be implemented. Transfer of share in case of liquidation of company in the hands of liquidated company. The provision says where the asset of a company are distributed to its shareholder on its liquidation, such distribution shall not be regarded as transfer by the company for the purpose of section 45. So company has been escaped. The above section is restricted in its application to the circumstances mentioned therein. The asset of the company must be distributed in species to shareholder on the liquidation of the company. So if the asset has been distributed to only the shareholder, not the outsider, then this benefit you can claim. If, however, the liquidator sells the asset of the company, resulting in a capital gain and distribute the funds so collected, the company will liable to pay the tax. So if distributors sell the asset and get the money, and that money has been distributed, in that case, capital gain would be there. But if the asset has been distributed to the shareholders, then in that case, there would not be any capital gain in the hands of a company, because there is one more concept. Does not mean that they have escaped from the tax liability. If in case of a liquidation, if company distribute asset to its shareholder, no cap gain on company, because we are not charging anything from the shareholder. But in this situation, shareholder need to pay tax. It does not mean that company escaped, but shareholder need to pay tax. Whatever amount of asset he will receive, it would be his deemed income. We called it deemed dividend. And it would be taxable under income from other source. So under income from other source, we will discuss a topic of deemed dividend. And it is exactly the same condition. If company distribute asset to the shareholder on liquidation, then whatever amount of asset has been received by the shareholder, he needs to pay tax as deemed dividend. Company do not need to pay tax on capital gain. Okay. The provision has been given over here. What is exactly deemed dividend? There are multiple cases of deemed dividend under section 222A, B, C, D, E. We will discuss all these cases in income from other source. For the time being, what you have to learn, you have to understand this, that company need not to pay any capital gain because the chargeability upon shareholder. In the hands of shareholder, shareholder receive money on other asset from the company on its liquidation. They will be chargeable to income tax under the head capital gain in respect of shareholder need to pay tax as deemed dividend, as well as in case of capital gain also. He needs to pay tax in both circumstances. What are the circumstances that we are going to discuss? They will be chargeable to income tax under the head capital gain in respect of the market value of the asset received on the date of distribution or the money so received by them. The portion of the distribution which is attributable to the accumulated profit of the company is to be treated as dividend income under section 222C, refer income from other source. So for the time being, nobody will ask what is the meaning of accumulated profit. Nobody will ask what is the dividend income. Nobody will ask what is the deemed dividend. That we will discuss in income from other source. Why we are discussing these things over here? Because for understanding the capital gain chargeability in the hands of shareholder, their concept of deemed dividend a little bit has been explained over here. That's why its deemed dividend concept is here, which would be taxable in the hands of the shareholder. The same will be deducted from the amount received fair market value for the purpose of determining the consideration for computation of capital gain. So with the following chart, you will understand what we need to do in capital gain chapter. So in case of liquidation of company, distribution of asset by the company to the shareholder, not chargeable to tax for company. We need to understand the treatment in the hands of shareholder only. In the hands of shareholder, this is income from other source part, that accumulated profit distribution up to accumulated profit would be your deemed dividend under section 222C, and that would be discussed under income from other source. Now this is capital gain part. For the shareholder, market value of asset distributed minus deemed dividend would be the sale consideration for the purpose of shareholder. Suppose the money received was 10 lakh rupees, FMB of asset was 15 lakh rupees, and deemed dividend under section 222C. How it's need to be calculated, that is going to be discussed under income from other source. Suppose it is 8 lakh rupees. So what is my sale consideration? That means 25 minus 8. So my sale consideration would be 17 lakh rupees. So this consideration is for the purpose of calculation of capital gain. So the money received plus the fair market value of asset distributed minus deemed dividend under section 222C would be considered as consideration for the purpose of section 48, not as a sale consideration. It should be treated as the cost in the hands of that person for the purpose of future. When he will transfer these assets, the cost under section 48 would be treated as 17 lakh rupees in the hands of shareholder. The company which is in liquidation accumulate profit means etc. is going to be discussed under income from other sources. Now we have buyback of shares on section 46A. There would be a correction in the notes updated or uploaded on the portal in case of section 46A. So what correction I will make over here, you need to do it on your notes if you have downloaded it or if you have taken the print out of it. Fine. Only one correction is there. One provision needs to be omitted. So capital gain on buyback of shares or specified securities under section 46A. So what is the meaning of buyback? In short, anyone can tell me what is the meaning of buyback? In short, you have to tell me what is the meaning of buyback of securities or buyback of shares. 68, purchase your own shares. So when company decide to purchase its own securities from the shareholder, it would be buyback of shares or buyback of securities. Correct. Most of you have given the almost correct answer. Well done. So what is the capital gain implication, if any, or what should be the tax implication in case of buyback of share that we are going to discuss over here. There is change also. Before 1st October 2024, the provision was different, and on or after 1st October 2024, the buyback provision has been changed. So you can see in case of capital gain, multiple provisions has been changed during the previous year. Due to it, it become more complicated. Like the tax rate has been changed, the definition of long-term, short-term has been changed, the indexation concept has been changed. Now, the buyback of security concept has also been changed before 1st October 24 and on or after 1st October 2024. After this buyback of shares provision, we will take a short break. So in case of specified securities other than shares, any consideration received by a holder of specified securities other than share from any company on purchase of its specified securities is chargeable to tax in the holder of a specified security. The difference between the cost of acquisition and the amount of consideration you received on buyback would be your capital gain. So being a shareholder, whatever amount I will receive from the company as a buyback consideration would be my sale consideration. And whatever I have purchased or whatever is my normal cost of acquisition, etc., would be my cost of acquisition. And the remaining amount would be my capital gain. So we have prepared a table to make you understand the concept that is before 1st October 24 or on or after 24, because with these language, it would be really difficult to understand the difference between the provision before or after. So we have prepared two tables separately to make you understand the concept of buyback. So what the provision was before 1st October 2024. Please read carefully. Buyback of shares by domestic company. First case, buyback of shares by company other than domestic company. So you must have seen the difference. This is the buyback of shares by domestic company. These are buyback of shares by other than domestic company. And these are buyback of security by any company. So these are for shares by domestic or other than domestic. These are buyback of specified securities by any company. Now the taxability in the hands of company. Up to 30th September, or we can say before 1st October 2024, if any shares has been buyback by the domestic company, then company need to pay tax upon this 23.296%, including surcharge and cess. This rate has been imposed, subject to additional income tax. Whatever amount of buyback company is doing, it needs to pay tax at the rate of 23.296%. And what are the implication upon shareholder? There is no taxability upon shareholder in case of buyback of shares up to 30th September. Company needs to pay tax, but shareholder needs not to pay any tax. Everything is exempt under section 1034A. If it is a buyback of share of domestic company. Clear? If it is a buyback of shares of other than domestic company, then what will happen? Then company need to pay nothing. No tax in the hands of company, but assessee need to pay tax. Shareholder needs to pay tax. What should be the sale consideration? As we discussed, the amount received as consideration for buyback from the company, and normal cost, etc. need to be deducted. But under section 46A, shareholder need to pay tax upon the capital gain. Same in the case of any specified security buyback by any company. So the different provision was for shares by domestic company. For these two, the concept is exactly the same. This was up to 30th September 2024. Now the change has been there. The notes I have uploaded in which this concept has need to be removed. From 1st October 2024, look, these are same provision, no changes. The provision is only change in this case, the buyback of share by domestic company. Earlier, the company needs to pay tax. So I need to omit it, but it has been by mistake not able to omit that. So you have to cut it. There is no taxability upon company now. Now the taxability shifted upon the shareholder. So now the new provision says no tax on company in either of these cases. So companies has been removed from the tax liability in case of buyback of share from 1st October 2024. And in all cases, shareholder needs to pay tax. So these are the same cases. This is new. Whatever amount received by the shareholder on buyback of shares of domestic company would be treated as his income from other source as dividend. So suppose 10 lakh rupees received. So 10 lakh would be treated as a deemed dividend, dividend under income from other source in the hands of shareholder. For the purpose of capital gain, we will take the sale consideration 0, and whatever cost has been bared by the shareholder, suppose 7 lakh rupees shares has been purchased, that would remain the cost in the hands of shareholder. So resultant will be the loss, whether long term or short term, that can be carry forward a set of as per the provision. So in case of buyback of shares by domestic company, now domestic company needs not to pay anything. You need to correct the notes what I have uploaded earlier. Fine. Now the shareholder needs to pay tax upon this also. Earlier it was paying tax in this or this case. Now this is also applicable on the case upon shareholder. Whatever amount he will receive from the company as a buyback will be his income from other source as dividend. And we need to calculate the capital gain also. But for the purpose of capital gain, because the amount we received, we have treated it as a income from other source. So under capital gain, now the income would be, consideration would be treated as 0. And whatever amount he has purchased, paid on purchase of these share would be your cost of acquisition, etc. Resultant would be loss. That could be carry forward or set off, whatever is the provisions, you can do this. So under section 46A, buyback provision has been into two parts. Up to 30th September, in case of buyback of share by domestic company needs to pay tax. And in the hands of shareholder, it was exempted. But after this date, now domestic company needs not to pay anything. The amount we received will be a dividend under assessee hand, income from other source, and capital gain would be always loss because consideration would be always nil. The amount paid by the shareholder would be always the resultant into a loss. You could see how complicated these provisions are. Now we'll move on to the capital gain on transfer of depreciable asset, and it's a relief that it is very easy. The depreciable asset provisions are very easy. Then I guess we have slump sale provision ahead. These are also very easy. And after that, I guess, yeah, the I guess last provision for this chart, chapter one will be there. Before that, we will do the MCQ. After the break, we will go for a MCQ, a short story. Then we will move on to the depreciable asset provision. Let me see if there's any query we can answer. Okay, you have, there was no query yet. So, Ashok sir, can we take a short break for 10 minutes? Okay, tech team Ashok sir, let me call you. सर ब्रेक कर दीजिए मैं आपको ठीक Okay. So welcome back, everyone. We are discussing the provisions of capital gain, and we have gone through with the provisions of conversion of capital gain today, compulsory acquisition, destruction of capital asset. Then we have discussed liquidation of company provisions and buyback of shares. So capital gain is a very important topic. I'm telling you, out of this topic, there must be questions in your examination papers. At least 5 or 6 or 7 marks questions would be from this chapter at least. So now the story time, and then we will move on to our other provisions for today class, like capital gain on depreciable asset, and might we are able to complete the slum sale provisions also. And of course, before that, MCQs will be there. So I believe you must have your pen, paper, calculator with you. So the story is interesting, a very simple story, very short story, and I believe आप में से बहुत लोगों ने वो सुना भी होगी, शायद काफी बच्चों ने सुनी होगी, बट वो मुझे काफी अच्छी लगती है स्टोरी। तो एक क्लासरूम था, वहाँ एक टीचर थी, और टीचर उस दिन क्लास में चिल्ड्रंस डे था, तो बच्चों के लिए केक लेकर आते हैं, और वो एक केक एक प्लेट में रखती हैं, और एक अपनी जेब से 500 रुपए का करेंसी नोट निकालती हैं, और फिर केक जमीन में गिर जाता है। और केक गिरने से पहले वो सारे बच्चों से पूछती है, किसको केक चाहिए खाने के लिए। तो सारे बच्चे हाथ खड़ा करते हैं कि मैम वी नीड टू ईट दिस केक। फिर पूछती हैं सबसे, किसको 500 रुपए का ये करेंसी नोट चाहिए। तो सारे बच्चे उसके लिए भी हाथ खड़ा करते हैं कि हमें चाहिए। और उसके बाद दोनों को नीचे गिरा देती हैं, केक को भी और उस करेंसी नोट को भी। ऑफ कोर्स केक खराब हो जाता है, उसमें डस्ट लग जाती है, गंदा हो जाता है, डर्टी। एंड ऑफ कोर्स जो नोट था वो भी जमीन में गिरता है, गंदा हो जाता है, डस्ट लग जाती है। वापस से दोनों चीजों को उठाकर अगेन शी आस्क्ड कि किस किस को केक चाहिए। तो अभी क्लास में कोई भी अपना हैंड रेज नहीं करता, किसी को भी केक नहीं चाहिए। जो 2 मिनट पहले सबको चाहिए था, अब किसी को केक नहीं चाहिए। बट व्हेन शी आस्क्ड अबाउट दैट करेंसी नोट, किस किस को ये 500 रुपए चाहिए, तो अभी भी सारे बच्चे अपना हैंड रेज करते हैं कि हमें चाहिए। सो द मोरल ऑफ द स्टोरी इज, आपको अपनी वैल्यूज 500 रुपए के नोट जैसी बनानी, चाहे वो कितना भी डर्टी हो, लेकिन उसकी वैल्यू एग्जिस्ट करती। तो आप कितनी बार भी एग्जाम देते हैं, मान लीजिए वो एक बार में नहीं निकलता, आप फेल हो जाते हैं, आप दोबारा से एग्जाम देते हैं, तो हम कितनी बार में सीए बनते हैं डज नॉट मैटर, अंटिल वी आर अ चार्ट अकाउंटेंट वी हैव दैट वैल्यू। और उस वैल्यू की सब रेस्पेक्ट करते हैं। तो लाइफ में कितने भी स्ट्रगल होंगे, कितने भी प्रॉब्लम्स आएंगे, कितनी बार भी हो सकता है ग्रुप क्लियर नहीं होगा, बट स्टिल इफ यू एबल टू कंप्लीट दिस सीए कोर्स, यू वुड बी वैल्यूड लाइक दैट करेंसी, एंड यू वुड हैव अ लॉट ऑफ वैल्यू। एंड जो लोग उसकी वैल्यू समझते हैं, उनके लिए आप हमेशा डिमांड में रहोगे। तो कभी ऐसा लगे कि सीए करते हुए टाइम हो गया है, अभी ये नहीं निकल रहा, अभी और कितना टाइम लगेगा, बट बिलीव मी, इट विल ऑल वर्थ एवरीथिंग। So whatever you are putting, whatever efforts you are putting for your this journey, they will all worth. It will be payback whenever you will be a CA. So please अपनी वैल्यू को उस करेंसी की तरह बनाइए, कितना भी डिप्रेशन हो, कितना भी प्रॉब्लम हो, बट ये ध्यान रखो, योर गोल इज टू बिकम लाइक दैट वैल्यू, दैट उसकी वैल्यू कितनी बार भी गिर जाए लेकिन वो कभी कम नहीं होती। So with these words, we will continue our class, and let's see. Small clarification required, sir. In case of buyback done on 30th September 24, index will not be done on cost of acquisition. Yes, of course, you are absolutely correct, Hardik. Absolutely correct. Right. So we are going to study the provisions of capital gain on transfer of depreciable assets, section 50. Now, this is a interesting topic for me also, because that is easy for me in some context, because you have gone through with the provisions of depreciation under PGBP head. So your PGBP head has been completed. So I believe that a lot of things you must already been understood regarding these depreciable assets. And you will see a very interesting thing. In case of depreciation or depreciable asset, there is a concept of block of asset that you must have gone through with the provisions of PGBP. And the block of asset definition says, once an asset comes into the block, its individual identity ceased to exist. Once an asset comes into the block, its individual identity sees two exits. So if there is a block of asset of 10 machine and one new machine added into that block, then we will say there is a value of 15 lakh rupees for a single block. We does not identify the separate value of the asset in case of income tax, in case of depreciable asset. So the block concept is like this. Once an asset comes into the block, it would be part of that block of asset, no separate identities there. So if that asset will go somewhere, the whole block will follow it. Or if the whole block is going somewhere, automatically that asset is including in that block of asset. So why I'm telling this thing in capital gain, because to understand the concept of capital gain in case of depreciable asset, the block of concept must be cleared in your mind. So the block means any asset will come, it will be the part of the block. You cannot separate it from the block. Wherever the asset go, the block will follow. Wherever the block will go, the asset will follow. Understood? Or I guess you must all. One very interesting thing also, when you are able to claim depreciation in case of block of asset, you are not able to claim short term, or you're not chargeable to capital gain chapter. Either depreciation would be there or capital gain or loss would be there. They cannot apply simultaneously. These are exclusive case. Clear? These are exclusive case. So if capital gain provisions are applicable in case of depreciable asset, in that case, depreciation would not be, you are able to claim under PGBP head. And if you are able to claim depreciation under PGBP head, then you cannot claim capital gain concept in case of these depreciable asset. How it will be there, how it will happen, what is the provisions, what is the concept, that is going to be discussed one by one. A capital gain arising of transfer of block of asset is to be treated as short-term capital gain. So the first concept is all depreciable asset gain would be short-term capital gain or loss. There is no long-term capital asset concept in case of depreciable asset. That's why there is no indexation concept applicable in case of depreciable asset. The gain or loss, whatever arises on block of asset, would be short term always. Capital gain will arise when full value of the consideration received. Let me show with you help of an example that would be more easy for all of you to understand. Okay. So now we are discussing about the block of asset concept. Suppose we have a block of asset. In this block, we are having asset A, B, C, D, E, F. On 1st April 2014, the opening block of asset consists these assets. But for the purpose of income tax, we will call it, suppose, block number 1 having the depreciation rate of 15%. Now, for the purpose of capital gain, there would be two situations in which capital gain could be applicable. First of all, whole block of asset sold. Okay, the opening block of asset including A, B, C, D, E, F. Suppose one new asset also purchased. Asset number G. Opening block of asset was suppose 20 lakh rupees. A new asset G has been purchased for 5 lakh rupees, and that has been purchased in previous year 24-25. So now there would be two situations when whole block of asset has been sold, or the second case when whole block of asset not sold. So when I say when whole block of asset has been sold, that means we have sold all these assets A, B, C, D, E, F and G also, because once we purchase G, that will form part of your block of asset. It cannot be separated. So A, B, C, D, E, F, that means these 6 assets plus G 7. So that means when I say whole block of asset has been sold, that means all 7 assets has been transferred. So if whole block of asset has been sold, there would always be short term. So there is no requirement to calculate the period of holding. They are always short term gain or loss in case of depreciable asset. So what we need to take, we need to find out the sale consideration. That will be given in question for all 7 assets because we have transferred whole block of asset. All 7 assets, the sale consideration would be there. What we need to reduce from it, we need to deduct the opening WDV of block of asset. So that means we are going to reduce 20 lakh rupees from this. That means from A till F, less asset purchased during previous year. That was rupees 5 lakh. The resultant would be the short-term capital gain or short-term capital loss, depending upon the sale consideration. Suppose case 1 sale consideration, suppose 32 lakh. So if it is 32 lakh, that means we have short-term capital gain of 7 lakh. Clear? Suppose it is 21 lakh. So in that case, we would have a short-term capital loss of 4 lakh rupees. So whether it would be a loss or gain, we have to calculate if whole block of asset has been sold. Now you can see the treatment would be under capital gain chapter. So there could not be any depreciation allowable in these cases. Why? Suppose if I'm asking you to calculate the depreciation in this case, then how depreciation is going to be calculated? The format is opening WD plus asset purchased, actual cost of asset purchased during the previous year, less the concept is money received. Clear? And a very important provision you must have remember in case of depreciation. Okay, I won't tell you. I believe you must have known this. So let me ask you this question. If the opening WD is 20 and asset new purchase is 5 and money received is in first case was 32 lakh. So how much we are going to reduce it from over here? 25. The money received cannot exceed the WDV and the new asset purchase value. So how much debt we can claim in this case? No depreciation would be there. In this case, if the sale consideration is 32 lakh. Suppose in this case, the sale consideration is 21 lakh in the second case. Then we have value of 4 lakh rupees. So how much depreciation we can claim in this case? In this case, there could not be any depreciation. How much depreciation we can claim in this case? Sukhveer is saying 60,000. I guess the 15% rate. Very good, Sukhveer. Anyone else? How much depreciation we can claim in this second case? Okay. Abhishek is saying no DAP. Okay. Ardik is saying okay. VR is saying 60,000. Ajay Surya is saying there is no asset, so no DAP. Correct. For claiming depreciation under PGBP, you must have read that these two conditions should be fulfilled. There must be value plus asset both in the block to claim depreciation. Value and asset both. In this case, we do not have value. So automatically you are not going to charge any DAP rate. Even there is no asset, but because there is value is 0, so you won't be able to charge DAP. But in this case, generally student can do this mistake, but because they have value, so maybe they are going to charge DAP at the rate of 15%. as multiple students sends me the answer of 60,000, this is wrong because in this case, value exists, but there is no asset. Why there is no asset? Because whole block of asset has been sold. So if whole block of asset has been sold, that means there is no asset, and for the purpose of claiming depreciation, there must be asset and value, both conditions should be satisfied. So no DAP in this case and no DAP in this case. And I have told you earlier also, if the treatment is under capital gain, in this case, there is a capital gain, and in this case, there is capital loss. So if in the both case, the treatment is already in capital gain chapter, then in both case, there could not be depreciation at all. So either DEV will be there or either gain or loss would be there. Understand? Sure. Second part. When whole block of asset does not sold. Now suppose in this case, we are saying asset A, B, C, and F has been sold only. So technically there are D, E, and G still in the block. So only 4 assets has been sold out of this block of asset. Even 4 sold, 5 or 6. Any other case, when all 7 has not been sold, case number B would be applicable. Clear? Now, how to calculate the gain or loss in this case? Again, same case, sale consideration less. The interesting thing, again, the same whole block value would be deducted. Why? Even one asset would be sold off, but the whole block would continue with that asset. That's why the concept says once an asset comes into the block, individual identity cease to exist. So even one asset will move. The cost of whole block needs to be deducted. Whole block of asset opening WDV on 14024 need to be deducted. That means 20 lakh. Even asset G does not sold, but again it becomes the part of the block of asset. So the purchase price of new asset also need to be deducted. The resultant will be gain or loss. Now we will see. Suppose these 4 assets has been sold for 32 lakh. So now this would be short-term capital gain of 7 lakh. And now suppose the sale consideration was not 32 lakh, it was 21. So this 20 minus 5, that will be short-term capital loss. But now the interesting thing, this would not be calculated. Capital gain provision not applicable if whole block of asset does not sold, and if there is loss, then that would not be chargeable under the head capital gain. Only profit if there, then capital gain would be chargeable to tax. But if there is loss, then that would not be chargeable under the head capital gain. Why it is not chargeable? Because in this case, depreciation would be allowable under PGBP head in this case. How? Let me show you. If this case need to be sold under PGBP, so now we will see opening WDV 20. Then new asset purchased value is 5. Less money received in respect of A, B, C, F asset. That was 32. So we can reduce only maximum 25. So the value would be nil. So in this case, value does not exist, but assets are there. But there is no value, so we cannot claim DAP. So if there is no DAP, then there would be capital gain concept automatically applicable. But in this case, if you'll see, opening 20 plus asset G5, 25 less money received. Now money received only for A, B, C, and F, and that is only 21 lakh. So now you can see we have 4 lakh remaining and value exists. Plus we have assets also in the block remaining. That is asset D, I guess asset E and asset G is there. So value and asset both are there. So we are going to claim depreciation in this case. 15% or whatever amount, depending upon G has been purchased for more than 180 days used or not. But for time being, I am clarifying this, that why not capital gain applicable over here, because we are going to claim depreciation in this case. So if depreciation is going to be claimed in this case, so that means we cannot claim the benefit of short-term capital loss of 4 lakh, because if depreciation allowed here and loss is also allowed here, so we are technically taking the double benefit of losses, that is not allowed. So only in these 4 cases, only this is the case in which depreciation is allowable, and automatically if depreciation is allowable, then there would not be any loss. So in a summary, I can tell you, if the whole block of asset has been transferred, you can see over here, then the treatment would be always under capital gain chapter, not under PGBP in any case, if the whole block of asset has been transferred. But if whole block of asset has not been transferred, then capital gain would be applicable only if there is gain, because there would not be any debt. But if there is a loss, then automatically it means there would be depreciation. So capital gain would not be applicable. Understood? So when there is a depreciable asset question, kindly see if all block of asset has been transferred, you can go for calculation of gain or loss, not worry about the PGBP concept. But if not block of asset, whole block of asset not sold, then you have to see if there is gain, then it would be my short-term cap gain. But if it is loss, you can cross it and write it down not applicable, because depreciation would be there in that case. I hope it's clear now. Moving on to the provision that has been explained over here. Special provision for computing the capital gain in case of depreciable asset in section 50. You can see case A, when sale consideration of one or more assets. So in the diagram, my case A was whole block of asset has been transferred, but technically this is case B of as per diagram, when whole block of asset does not transfer. When one or more asset transfer, then we will apply gain only when there is short-term capital gain, not in case of loss. But if whole block of assets cease to be exist, so this is my A case as per the diagram. When whole block of asset has been transferred, then it does not matter whether there could be gain or loss, whatever it is. There's an example also regarding this. So before that example, I guess now we should start our MCQ. And if we have spare time, then we will go for this example. So I guess you must have your pen, paper, etc. with yourselves, and calculator also. Question number 1. Kindly read it. Conversion of capital asset into stock in trade will be liable to capital gain in the previous year in which such conversion took place, will be liable to capital gain tax in the previous year in which such converted assets is sold or otherwise transfer, not result into capital gain or none of the above. So I believe it's very easy for all of you to understand what is the correct answer. The correct option is of course B. The correct option is option number B, of course, because it says lot of you has given the answer, and I guess everybody must have given the correct answer. Because very, very easy question. I am just checking anybody has given the wrong answer. No, everyone sent the correct answer. That is option number B, of course. The capital gain would be chargeable in the year in which such stock in trade has been transferred. Please check on the query portal also. Question number 2. Okay. Second is saying where the capital asset is converted into stock and trade, the indexation of cost of acquisition and cost of improvement shall be done till the previous year of conversion of such capital asset, or shall be done till the previous year in which such asset is sold. So the correct option is of course option number A. If anybody has given B, okay, I'm okay, A, correct. Everybody is given the correct answer, A. So of course, in case of conversion, in case of destruction of asset, in case of compulsory acquisition, the concept will remain the same. That the transfer date would be the conversion or compulsory acquisition or destruction. So all the provision, whether it's for period of holding, whether it's for indexation, will be according to that date till which that transaction regarded as transfer. So the correct option in this case is of course option number A. Next is where a capital asset other than certain urban agricultural land is compulsory acquired, then the capital gain shall arise in the previous year. What is the correct answer? Where a capital asset other than certain urban agricultural land is compulsory acquired, then the capital gain shall arise in the previous year. So the correct answer is of course in which part or full consideration has been received. Absolutely correct. Well done. These are very simple question, of course. Question number 4. Where the entire block of the depreciable asset is transferred after 36 months, there will be, what is the correct answer? Kaveri is saying A. Look, that's what I'm saying. Na? In MCQ, you might feeling that A is the correct answer. Ajay Surya is also saying A. Very wrong, very wrong. The resultant could be short-term gain or loss. Somebody is saying D. If you are seeing the first option is short-term capital gain and you are taking it, so it might be wrong because there could be other option. Na? What if there is a loss? Then you answer. If you are answering this question A, that means you are always imagining that there would be only gain, there would not be any loss. That could be a wrong answer because we have option number C also. So according to C is the much wider and correct answer. So there could be short-term gain or short-term loss. We are not asking that whether it's a short-term capital asset or long-term capital asset. We are talking about the gain. So it would be always short-term capital gain or short-term capital loss. The correct option is option number C. Next is, somebody was asking, Miss Moroju, sir, can you please explain how 23.296% is calculated in taxability of company? Okay, so on or before, or we can say before 1st October 2024, company needs to pay tax, domestic company, and that was 23.296%. So it was like this: 20% tax rate, surcharge 12%, and then 4% cess would be there. So if you calculate this, this would come 23.296%. Okay, question number 5 now we have. That is a numerical question. I have already solved it. R owns a house property which purchased R owns a house property which purchased by him on 11,596 for rupees 3 lakh. The said property was destroyed by fire on 3rd April 2015 and R received a sum of rupees 50 lakh from the insurance company during the previous year 24-25. The market value of our property was 4 lakh rupees. Compute the capital gain for assessment year 25-26. So now this is a case of exceptional circumstances in which we have discussed that the year of transfer and the year of chargeability would be different. So of course the year of transfer would be this, that would be 15-16, and the chargeability year would be of course assessment year 25-26. So according to that, what should be the correct answer? You must have given some option number B. Hardik is saying option number B. Prakriti Yadav is saying B. Neeru Rachna is also saying B. Very simple to solve. So when we practice these questions, these are not that difficult in comparison to that time when we discuss those as theoretically. So what should be the period of holding? In this case, the period of holding would be from 96 to 2015. Clear? The sale consideration would be 50 lakh. Now, what is the cost of acquisition? The cost of acquisition would be 4 lakh rupees. And the index, the transfer year would be 15-16. So the index of 15-16 would be 254. And lower index would be 100. So that would be 1016,000. My index cost of acquisition, and the remaining 3984000 would be the long-term capital gain. Next, Mr. Ram has made an agreement from purchase, Mr. Raman, for purchase of building and paid 1 lakh rupees in advance to Mr. Raman on 1/10/23. Mr. Ram was not able to pay balance consideration within time as per agreement. So Mr. Raman forfeited advance of rupees 1 lakh in previous year 24-25 in which head rupees 1 lakh is going to be taxable. And of course, it's a very, very easy option. And we have discussed that if the advance money has been forfeited on or after 1st April 2014, I guess, then whatever amount is forfeited is going to be your income from other source. This 1 lakh is going to be taxable in the hands of Mr. Ram for income from other source. But what if this question belongs to before 1/4/2014? Suppose if this is a forfeiture of before 1/4/2014, suppose the question is like this: as advance to Mr. This is 2013, suppose, not 23. Ram was not able to pay, so Mr. Ravan has forfeited. So the income would be taxable in the hands of Mr. Raman if income from other source. But suppose if I change the question, Mr. Ram was not able to pay balance consideration within time as per agreement, so Mr. Ravan forfeited the amount in, suppose, previous year 13-14 only. In which head rupees 1 lakh is going to be taxable? There would not be any treatment in that year. The treatment would be in future year in which Raman is going to sell these assets. So if suppose Ravan is going to sell this asset for rupees, suppose, 50 lakh, and the purchase price was, Ravan purchased this building for 20 lakh rupees in 2004 and sold it in 2024 May. Then the provision will say that the sale consideration is going to be whatever in the question has been given, but whatever is the cost, the purchase price would be reduced by the amount of money forfeited. So now the purchase would be 19 lakh rupees instead of 20 lakh, and this 19 lakh need to be indexed, etc. So that was the provision before 1/4/2014. Of course, not relevant for your examination, but because it has been given your study material, so I just given you a simple example that if that belongs to a preceding year, then what should be the treatment? No treatment in income from other source, but whenever that property is going to be transferred, that cost of acquisition of that property needs to be reduced by the amount of advance forfeited by the assessee. Okay. Next is Mr. Ravan invested rupees 1 lakh on the purchase of gold jewelry on 28th March 2005. On 8th February 16, he started a business of dealing in jewelry and convert his holding into his stock in trade. FMV of the gold ornaments as on the date of conversion was 4 lakh rupees. These jewelry were sold in the previous year 24-25 for a sum of rupees 5 lakh. Compute the capital gain and business income. So what should be the correct answer of this? This is the case of conversion of capital asset into stock in trade. Okay, Hardik has given the answer. Anyone else? Okay, Ms. Kashyap is saying A. Rashmi is saying A. Okay, Prakriti is saying A. And of course, what is the correct answer? The correct answer is A. In the pre-assessment year 25-26, we need to solve it. But the period of holding would be from, of course, 2005 till 16. The sale consideration would be taken 4 lakh rupees as the FMV at the time of conversion. and the index also need to be applicable accordingly the conversion date. So the cost was 1 lakh into 254 upon 113. So the resultant index cost of acquisition would be 224,778. So the remaining would be 175,222. I hope it's clear. And the business income would be like stock in trade sale value is 5 lakh. And the FMV which has been used as under capital gain would be the purchase price, that would be 4 lakh. So 1 lakh would be your PGBP income. भावना is saying सर मुझे इंडेक्स वैल्यू ऑफ कॉस्ट ऑफ एक्विजिशन कैलकुलेट करना नहीं आ रहा. वैसे तो भावना हमने आई गेस फर्स्ट सेशन और सेकंड सेशन में सब सीखा है, बट मैं आपको बता देता हूँ बहुत इजी है. जो कॉस्ट ऑफ एक्विजिशन है, जैसे कि इस क्वेश्चन में कॉस्ट ऑफ एक्विजिशन समझ आती है आपको. कॉस्ट ऑफ एक्विजिशन इस क्वेश्चन में हमारी कितनी है, 1 लाख रुपीज. ये समझ आता है, ठीक है. अब जो ऊपर हमें इंडेक्स चाहिए होता है ना, एक तो याद रखो इंडेक्स हमेशा फाइनेंशियल ईयर के हिसाब से आएगा, असेसमेंट ईयर के हिसाब से नहीं आता. एग्जाम में भी जब क्वेश्चन में दिया होगा इंडेक्स तो फाइनेंशियल ईयर के हिसाब से दिया होगा. तो ऊपर इंडेक्स आता है हमेशा ट्रांसफर ईयर का, जिस ईयर में एसेट ट्रांसफर होती है. अब इस क्वेश्चन में कन्वर्जन को ही हम इंडेक्स मानते हैं, कन्वर्जन को ही इंडेक्स माना जाता है. तो नितिन बता रहा है कि इंडेक्सेशन स्टडी के पेज 3.394 पे दिया है. इंडेक्स की वैल्यू क्वेश्चन में गिवन होगी, ठीक है. इंडेक्स हमेशा एग्जाम में गिवन होगा. किस ईयर का इंडेक्स कहाँ यूटिलाइज करना है वो मैं आपको बता देता हूँ सिंपल लैंग्वेज में. तो ऊपर हमेशा इंडेक्स आता है ट्रांसफर ईयर का. अब कन्वर्जन वाले केस में ट्रांसफर अब कम मानते हैं जब एसेट कन्वर्ट होती है. अभी आप देखिए कन्वर्ट कब हुई है, 8 फरवरी 2016. अब ये बता दो मेरे को 8 फरवरी 2016 किस फाइनेंशियल ईयर का पार्ट मानी जाती है, बताओ. भावना विल आंसर कि 8 फरवरी 2016 किस फाइनेंशियल ईयर का पार्ट हुई. सिर्फ भावना आंसर देगी 15-16 का. करेक्ट, वेरी वेल डन. तो अगर 15-16 का है तो 15-16 का इंडेक्स फाइनेंशियल ईयर का क्वेश्चन में एग्जाम में गिवन होगा. और हमें पता है कि 15-16 का इंडेक्स कितना है, 254. तो हमने मल्टीप्लाई कर दिया इसका 254 से. अब ये एसेट खरीदी कब गई है, तो देखिए बता रहे हैं 1 लाख रुपए की एसेट थी जो खरीदी गई मार्च 2005 में. तो नीचे इंडेक्स आता है उस ईयर का जिस ईयर में एसेट को खरीदा जाता है. या फिर अगर वो सन 2001 अप्रैल 2001 से पुरानी खरीदी है तो हमेशा 100 आता है. अब ये तो 2001 के बाद खरीदी है, तो 28 मार्च 2005 किस ईयर का इंडेक्स हुआ, 2004-5 का 100 थोड़े ना था इंडेक्स, क्या लिख रहे. हाँ, ये इंडेक्स है 2004-5 का. अगर पुरानी है 2001 से तो हमेशा 100 आएगा. तो नीचे इंडेक्स किसका लेंगे हम, 4-5 का. अब 4-5 का इंडेक्स है 113. तो हमने 1 लाख का मल्टीप्लाई करा 254 से और डिवाइड करा 113 से. 4-5 फाइनेंशियल इंडेक्स 113 है. इसे आप सॉल्व करेंगे तो आपके पास ये वैल्यू आ जाएगी जो हमने निकाली हुई है. ये क्लियर हुआ कुछ भावना. बट ये 2001 से पहले थोड़ा ना है, ये तो उसने ज्वेलरी खरीदी है 28 मार्च 2005 में. पहले का कहाँ है, इस एग्जाम्पल में थोड़ा ना पहले का है. वो तो पिछले एग्जाम्पल किसी में पहले का होगा जिसमें पहले खरीदी हो. परचेज ऑफ गोल्ड कब है, 28 मार्च 2005. तो 2005 तो 2001 के बाद भी ना. हाँ, यहाँ लिखा होता 28 मार्च 1995. तो 1995 होता तो हम 100 लेते. अच्छा, इंडेक्स वैल्यू कहां से लेंगे, वो क्वेश्चन में गिवन होगी, चिंता मत करो. हर क्वेश्चन में एग्जामिनर लिखकर देते हैं इंडेक्स वैल्यू. जो जो इंडेक्स वैल्यू यूटिलाइज होनी है सारी लिख कर देते हैं. बस आप दो वैल्यू सब लोग याद रखेंगे खुद से. एक तो फर्स्ट ईयर की मतलब 2001 से या पहले वाली, दैट इज 100. और एक करंट ईयर की जो चल रही है दैट इज 363. इसके अलावा जो भी इंडेक्स या ईयर होंगे उनकी इंडेक्स वैल्यू क्वेश्चन में गिवन होगी. चलो, नेक्स्ट इज क्वेश्चन नंबर 8. A firm consists of partners, namely A and B. B retires from the firm on 11th July 2024. The firm transferred its land to B in settlement of his account. The market value as on that date was 35 lakh. The land was acquired by the firm on 9 September 2004 for 10 lakh. Compute the capital gain in the hands of the firm. करो बच्चों, इसके लिए इसमें प्रोविजन लगेगा सेल कंसिडरेशन इन केस एसेट हैज बीन ट्रांसफर्ड बाय फर्म टू द पार्टनर. तो सेक्शन 45 4 applicable है, उसके अकॉर्डिंग वी ऑलरेडी नो what should be the sale consideration in this case. So kindly solve this question, otherwise I will going to solve it. Okay, Rachana is saying it's B. Smita is saying B. Rashmi is saying B. Well done. Hardik also said B. Nitin B. Of course, the correct answer is option number B. Now, when a partnership firm transfer its asset to the partner, the sale consideration would be the FMV. So the FMVs in question is 35 lakh. Now all other thing will be normal. This is not a specific case or some special question. It's a simple question. The cost is 10 lakh rupees into 363 upon 113. So the value would be 3212389, and the remaining would be like 287611 will be your correct option. Well done. 2 more to go. Question number 9. Mr. Ram applied for enhanced compensation for his property, which was compulsory acquired by government, and received enhanced compensation of 5 lakh in previous year 24-25. Index cost of acquisition of that property was 2 lakh and index cost of improvement was 40,000. Calculate the capital gain on EC for assessment year 25-26. Smita is saying D. Hardik is saying D. Ms. Kashyap is saying B. Aisha is saying B. Very well done. Of course, because we have discussed that in case of enhanced compensation, B कौन कह रहा है? B कैसे हुआ? Okay, in case of enhanced compensation, the cost of acquisition, etc., would always be treated as nil. So whatever you will receive would be your capital gain. So the correct answer option would be 5 lakh rupees. Now the last question. Okay, this question we cannot solve yet because we did not discuss the provisions of this question. So question number 10 will be discussed later. Moving on to the provision. The question of depreciable asset, that is Singhania and Company, a sole proprietorship. Okay, next class we will complete this assignment, this topic number 1, that is part 1 of capital gain, and we will also solve test your knowledge question related to these topics. So kindly you should have your paper, pen and calculator in the next class from the starting of the class. Fine. So Singhania Company, a sole proprietorship, owns 6 machines put in use for business in March 23. The depreciation on these machines is charging at 15%. The WDV of these machines on 1st April 24 was 850. 3 of the old machines were sold on 10th June 2024 for 11 lakh. A second-hand plant was bought on for 850 on 30th November 24. So determine the claim of depreciation for assessment year 25-26. The first question is related to PGBP. I don't know why they are asking in capital gain, because they might need to see that whether you know when to claim depreciation or not. Okay. So we have the solution. WDV of the block has been given 8,50,000 rupees and purchase of a new machine is for 8,50,000 rupees. So total value of the block we have is 17 lakh. Now the question says 3 of the old machine. That means still block of asset exists. 3 of the old machine has been sold for 11 lakh rupees. So the WDV of the block is 6 lakh. That means value exists as well as the assets also exist. And because these both is exist over here, so technically we can claim the depreciation. That means capital gain would not be applicable. How to claim depreciation? This is old and this is new asset. The new second-hand asset has been purchased on 10th June 2000. Sorry, in November, 30th November. So that means it has been used for less than 180 days. So when you sold any plant and machinery, and it has been specifically stated that it has been sold 3 old machines. So that means this 11 lakh would be reduced firstly from this value 850. So my opening WDV would remain nil for the purpose of depreciation. Now out of this 11 lakh, 850 has been used from opening WDV. The remaining 2.5 lakh would be used from new asset value. So the remaining new asset value would be in the block 6 lakh rupees. So the depreciation would be half of this because it has been used for less than 180 days. So we can find out the depreciation that would be 45,000. You can see over here. I don't know why I'm solving it because the depreciation concept you must have understood already in the PGBP head. Compute the capital gain to tax for assessment year 2026. So we have already seen that if there is depreciation, there cannot be capital gain. So you can prove it because in this case, there would be loss. And if there is loss, there's short-term capital loss for not transferring whole block of asset that would not be applicable in this case. So in this case, you can see capital gain would not arise. But now, if the 3 machines are sold in June 2024 for 21 lakh, not for 11, if it has been transferred for 21 lakh, then you can see the opening was 8.5 and this is 8.5. Now the consideration is 21 lakh. This was 17. So there would not be any value. So no debt. But now capital gain would be there. 21 lakh rupees the consideration. 8.5, 8.5, 17 lakh would be the cost and the purchase of new asset, and 4 lakh would be your short-term capital gain in this case. So in the solution, you can go through it, of course. So now we have slum sale provision. It's a very interesting provision. And let me tell you, if the question from slum sale is going to be asked in the examination, again, that would not less than 1.5 page. And if you know how to solve it, very interesting thing, the solution would not be more than 6 or 7 lines. The full solution would be there in just 6 and 7 lines would be there. So this is the main interesting part of slum sale. One more interesting part. If I'll ask you, what is the maximum time period to make any asset into a long-term capital gain on or after 23rd of July 2024? The time duration has been specifically divided into 12 months or 24 months. So there is no 36-month criteria. Now, on or after 23rd of July 2024. But let me tell you, there is a 36-month criteria is still there in case of slum sale. In case of slum sale, if that undertaking has been transferred after 36 months, it would be a long-term capital gain. And if it is before 36 months, it would be a short-term capital gain. So the 36-month provision is still there, but only for slum sale category. What is the meaning of slum sale, what and how we need to calculate it, etc. That is going to be discussed later. If there's any query, you can ask me, then we can conclude today's session. And we will discuss the slum sale and the other part of this part number 1 in our next session. That would be day after tomorrow. If there's any query, kindly ask me. Within is saying no query. Anyone else? Yes, Hardik. In case of preference shares, if those are converted into equity, then there is no cap gain. But if these are going to be converted into bonds or debenture, capital gain will arise. Ajay Surya is saying no query. Very good. Anyone else having any query? Yes, it would be same. So how many students started revision of income tax? I have asked you in the, I guess, first session of capital gain. But income tax is a kind of subject you cannot leave it for 1 month and you will think that I will restart it after 1 month. That would be a great problem. So I have asked you that please start your revision from chapter number 1 of income tax. Even if you are able to give your 30 or 40 or 45 minutes, that would be enough. But starting is must, and that would be make you a connection between all the provision, and you will be always in easy for revision. Income tax will not ever bother you if you start revision in the manner I have asked you. So are you giving 45 or 50 minutes every day, or at least 4 or 5 days in a week? And if you're doing so, let me tell you, you are gone through on a right track in case of income tax at least. So done till or done till date, well done. And I believe that when you are doing this, जब इनकम टैक्स रिवीजन आपने स्टार्ट करा होगा ना, और अगर किसी ने 25 या 20 या 30 डेज के बाद स्टार्ट किया है तो स्टार्टिंग बेसिक कंसेप्ट रेजोनेशन में प्रॉब्लम आ रही होगी. So you have class on YouTube. You can, of course, you can go through that. Again, किसी भी कंसेप्ट में प्रॉब्लम आए तो प्लीज उसको गो थ्रू करो. प्रैक्टिकल साथ में जरूर रिवीजन में सॉल्व करो. रिवीजन डज नॉट मीन दैट यू आर जस्ट गोइंग टू रिवाइज द प्रोविजंस एंड दैट्स इट. नो, यू हैव टू सॉल्व प्रैक्टिकल प्रॉब्लम ऑल्सो. प्रैक्टिकल प्रॉब्लम के रिवीजन के लिए आपको एक टिप देता हूं अच्छा सा. When you revise your question, and in case of that revision, if you are going through the test and knowledge questions, or if you are going through the illustration or previous year questions, whatever, तो उनमें से जो भी ऐसे क्वेश्चन हो जो रिवीजन में आपसे सॉल्व ना हो, लाइक यू आर ट्राइंग फॉर 40 क्वेश्चन और 30 क्वेश्चन, एंड उन 30 में से होगा क्या ना, ऑलमोस्ट 50% वो इजिली सॉल्व हो जाएंगे आपसे रिवीजन में, बिकॉज ऑलरेडी यू हैव गॉन थ्रू वंस विद ऑल द थिंग्स. बट जो बैलेंस 15 होंगे उसमें से माइट बी 5 6 7 ऐसे होंगे, दोज आर गोइंग टू बॉदर यू अगेन फॉर सॉल्यूशन ऑफ दोज क्वेश्चन. यू माइट need to give you more time, or you might to revise again, or you might to ask your friends or seniors. तो वो जो 5 6 क्वेश्चन होंगे 30 में से ना, प्लीज टिक देम एज इंपॉर्टेंट और वेरी इंपॉर्टेंट. क्योंकि जब इसके बाद रिवीजन स्टार्ट करोगे ना सेकंड टाइम, सो इफ यू आर एबल टू ओनली रिवाइज दोज 5 or 6 क्वेश्चन, those you have marked very important out of those 30 questions, so in only those 5 or 6 questions you are able to revise all kind of questions. So please mark these things, because in case of examination, when you have only 1 day left between the examination, so you would need to revise the practical question also. तो सारे नहीं कर पाओगे रिवाइज. तो जिन पर ये टिक्स लगे होंगे ना, वेरी इंपॉर्टेंट वाले, बहुत इंपॉर्टेंट वाले 2 या 3 टिक, एवरी टाइम व्हेन यू रिवाइज अगेन, तो उन 5 में से सिर्फ 3 रह जाएंगे, बाकी 2 आप सॉल्व कर लो. तो उन 2 या 3 या 4 को हमेशा आपको रिवाइज करना है एग्जाम से पहले. सो उससे आपका एक कनेक्शन एंड न्यूमेरिकल सॉल्व करने की प्रैक्टिस रहेगी. ओके. ओके, वेरी गुड. चलो, try this, and I guess now we need to conclude this session. All the best for all of you. We will see each other here day after tomorrow on 4th of December. Sir, can we conclude the session? Ashok sir. Ashok sir, can we conclude the session? Sir, gosh. You're welcome, everyone. कहाँ चले गए? वो कर देना जो मैं तुम्हें बताया था, मैं भी लाऊं.